Let's talk some more about today's action in the trade with Joe Tigay. He's a managing partner at Equity Armor Investments. Joe, are you looking at earnings and wanting to trade specific stocks right now, or are you just trying to stay afloat with the market that seems like it's going underwater?
Yeah, the market's flying around. I think a stock like CSCO, it might be prudent to step aside into earnings if you're just initiating a trade right now. If I were in it, maybe, again, like other stocks I'd be in, I'd want to get out into a stock replacement trade. I have one for CSCO, just for example, but the market is just moving around. It's not necessarily rewarding the good earnings right now, and it's really punishing the bad earnings, so it's not the best environment, even though I think CSCO is a fantastic stock. I'd like to own it in the long term. Okay,
so your point is, you know, if you're someone who is trying to trade or take out hedges, if you own the stock around earnings, you know, look, maybe that's the right move if you own the company, because the beats right now are kind of getting washed out in a market that's a high correlation trade, both up and down, right? Yesterday, stuff that's got nothing to do with the incoming tariffs had a big pop. Today, everything's basically down.
Yeah. Just like last week too, like this reaction, Monday down, Tuesday up, Wednesday. Last week had a reversal, we get that today. We'll see, but this market is just flying around. The VIX is 21, almost 21 right now, and it's justified. Maybe it'd even be higher. The front month future is at 20 right now, so we're seeing a lot of moves right in volatility. The market's flying around, and you know, I don't really know what's gonna happen next.
Well, nobody does, Joe. Tell me right now what you're looking at, though, okay? Because when VIX spiked up to 25, you were here with us the day basically that happened, right? And you guys from the options side said, look, vol usually doesn't stay here. This might be a way to trade premium, to sell volatility, just from kind of a probabilistic standpoint. Now we've got a VIX that's bouncing again off 20, so do we kind of rethink the range for the time being for where volatility might be?
Well, I mean, volatility, it's acting really normal today. We haven't made a new relative low in the market. The VIX also not making a new relative high. I think that's kind of normal. We're waiting to see if we do get a new low below that 2860 area. I think that is a really bad sign for the market, or it might test the lows we saw earlier. So yeah, then I think we could see a VIX start to take off, and of course it's all bunched in towards this expiration, so we got a lot going on. And of course next week we're talking about Jackson Hole. I think that's going to be a massive event for the market. Maybe they don't actually do anything. I don't know if the market's expecting that, but we're going to see a strong cue as whether or not the market's going to think their hawkish cut of last time is going to stand, only 2 cuts, or if they're going to be more dovish, we're going to see 3, maybe 4 cuts down the road. So we're going to get a big cue, and I think the market's going to move off of that. But I just come back to, I don't know how much that really matters. I don't think anything really is going to be settled until we get a real settlement in the trade situation. Yeah, if we happen to cut, we lower our currency. That doesn't do much with China. They're pegged to us, so if we go lower, they go lower. It doesn't do anything. If anything, it hurts Europe. Europe is the main spot where there's a global slowdown right now. So then, of course, I expect Europe would also be more dovish. And then where does it lead us? Of course, more fiscal stimulus. So that, in the end of the day, it has been good for asset prices, but has it been so good for GDP? I don't know. Maybe 9 to 10 months down the road, maybe that 210 signal we got this morning turns out to be prophetic, and we have that recession.
So, Joe, this is, to me, really what it boils down to, the relationship between yields and the stock market, because if you were to just look at someone who likes the Fed model and say, the yield today is at 1.6%, last week a bunch of global central banks cut their rates, and now it looks like the Fed's gonna do it, they go, hooray, buy stocks and equities. But yet that's not the relationship. So how important is it that now we have a relationship that looks like it's at risk of changing, where the market interprets low yields and inverted bond curves as something that's unwelcome? Can the Fed come in, even if they do talk emergency cut? Is that going to help this market, or does it basically confirm the signal that bonds are looking at recession?
I think, well, yeah, it may be both, but I still think it'll help the market for the short term. The market's going to be lifted because what do corporations do with these low yields? They just go around, like CSCO we were talking about before, they go around, they buy back their stock. Obviously that's good for asset prices. I think the problem we're going to see 9 to 12 months from now is going to be, if the economy slows down, do any companies who had borrowed money at these cheap rates have trouble paying them back because we're in a recession?
Sure. All right, Joe, we will keep the conversation going. Mr. Tigay, good as always. Appreciate you joining us from the CSCO. He's a managing partner at Equity Armor Investments.